It's a huge move in interest rates. It's a topic in virtually every conversation that happens about what's going on in the market. And I think there's also a little bit of a chicken and egg thing going on with interest rates and inflation expectations because, and I think you're going to ask me a question at some point today about inflation. That's the most common question that we're getting here is about inflation, concerns about inflation. What's going to happen to my today dollars? And I think we're getting headlines that are scary regarding inflation because of the move in interest rates, and basically no other reason. And the move in interest rates, everyone has maybe a slightly different variation of the story about what's causing it. One possibility is just that it's a recovery from what happened last year. Interest rates went abnormally low. I mean, they've been low for a long time, but they went lower than maybe they otherwise would have during the COVID scare. People piled into treasuries when the stock market was selling off. The 10-year treasury went down to like 60 or 65 basis points. And now it's substantially higher than that. But the reason that rates plummeted in the first place is because there was such a huge scare that the entire economy was going to be shut down for an indeterminate period of time. And now we're opening up. Things are starting to open up, and we're kind of on the other side, or we're in the inverse of the fear that was happening then. Now the fear is we're going to open up, and the government's spending all this money. There's going to be tons of inflation, and interest rates are reflecting that. It could be a little bit of all of those things. It could also be just maybe the end of the bond bull market, and maybe COVID marks the end of the bond bull market, which has been going for 40 years. That is the question that should be asked, I think, right now. And people have been, because this bond bull market, or the decline in interest rates to effectively zero over the last 40 years from double digits, from high double digits, people have been brainwashed into thinking that this part of your portfolio, not only will it be stable, but it will also make you money, and in some cases it'll make you a lot of money. I don't know that you need to look at the next 10 or 15 years in bonds as a money losing proposition. Maybe in real terms, when you sub out inflation, but for bonds to lose money, interest rates would have to go up, somewhat meaningfully. It would have to be a steady trajectory for interest rates over that period of time, because you are getting the coupon every year, and as long as you position yourself well with duration risk, meaning you stagger out the maturities of the bonds in your portfolio, I don't think you have to lose money. But the first part of your question is good, which is this, it's resetting expectations for that portion of the portfolio. And I think we've talked about that in previous videos, and we'll talk about it in future videos, because it's just a huge part of the market. It's a huge part of any retiree's portfolio. So I think it's just about resetting expectations, and what does that portion of your portfolio do? What do you expect it to do? And are those two things close to the same? You're going to get a fixed amount of interest each year, and you're going to get your money back, 100 cents on the dollar, at the end of the term. So you need to have your own view of what inflation is going to be. So there is a big discrepancy in performance across the fixed income universe. So for instance, a common benchmark for the long bond is TLT. Everybody references TLT. It's basically it's the largest index fund that holds U.S. Treasuries that are longer than 20 years in duration, and that's down like 14% on the year, which is an enormous move for that asset class, especially considering it's basically gone nowhere but up. It's nothing but gain in value for a long time. So it's lost double digits so far this year. And then you look at some other parts of the fixed income universe, like municipal bonds and high yield bonds. Those are both actually just about flat, maybe even a little bit positive. So high yield bonds would tend to do better in a rising interest rate environment than higher quality treasuries and corporate bonds. So that's not surprising. Municipal bonds, having done so well, even on the longer duration municipal bonds, that may have something to do with expectations for tax rates. Because tax rates fell under the prior administration, and that made the tax-exempt status of municipal bonds in relative terms less appealing. Now, if there's this prospect of tax rates going up at the high end, then municipal bonds become more appealing yet again. And so it's possible that explains munis having done so much better than both corporates and treasury bonds this year. It's an important topic, and I think there's multiple forces battling all the time. Right now, and Jerome Powell mentioned it in his, I don't know if it was his most recent press conference, maybe it was 2 press conferences ago. He mentioned the deflationary impact of technology and also globalization. So prices for a lot of the things that we use have come down. And I think we've talked about this before. The things that we use a lot of, you just think about your smartphone. Everybody I know has a smartphone. Certainly everybody with a job where you're interacting with other people and with the market or news, you have to have one of these devices. Those devices they've basically stayed about the same in price over the last 10 years. Maybe they've gone up a little bit, but if you consider what they do now and the processing power and memory and all that, they've gotten so much better, and they've allowed people to, you can almost work from your phone. A lot of people can work from their phones. And so that would be considered a deflationary impact that technology is having. What I can do with this $1,000 device versus what I would have needed in technology terms 10 years ago to complete all the same tasks. Faxing, scanning, emailing, all these things are just so easy now. That's a very rudimentary example. People do a lot more with technology than scanning and printing. But the cost of all these devices that we use has come down, and the quality's gotten better. So that's not inflationary. And it also probably helps explain why wages have remained relatively stagnant. And then you have the inflationary side of things, which is like healthcare, college tuition, or any sort of cost of education, childcare, food, those sorts of things, housing. These are big costs, and these are sort of the most visible ones. You look at what your house costs, and you hear about your neighbor being able to sell his house for 30% more than what he paid 2 years ago. Those are important, but a lot of costs on the other side of things have come down. The real answer is I don't really know, and I don't know that anybody does. Even the Fed sort of makes these adjustments in terms of what type of inflation they're okay with, or what level. They've adjusted it up. We're willing to let it run hot, which means that they're okay with inflation being at the upper end of this band that they've decided is acceptable. And I don't know. There's certainly inflation in assets. Like you said, housing prices and stocks, bonds even. All of these things have gone up in value. So I don't know where else inflation needs to show up. One maybe obvious example is in gas prices. That's not something that we talk about in this city all that much, but people that do a lot of driving for their job, if oil and natural gas double in price from here, we'll be hearing a lot about inflation and how much more it costs to commute an hour to work. I think maybe we're also not hearing about it because people aren't traveling as much right now, but in 6 months that could be different. A year ago when COVID was just getting started, or the scare was at its peak, we also had that issue where oil cratered and it went negative for a couple of hours. But there was a concern about global demand for oil and gas, and basically all commodities. And prices came way down, and so the cost to fill up went to basically its lowest in a long period of time. It started to crawl back, and I think people haven't really taken note yet because we're not filling up with the frequency that we were. That could change. And I think that's something that maybe by the end of the year people will be talking about more. Again, just our theme is really to not make huge changes, certainly not overnight, not make huge changes to an investment philosophy. What you're asking though is, if I knew for a fact that inflation was going to come roaring in for the next decade, what would I do? You could buy floating rate securities, securities that pay interest based on a certain spread over a benchmark, whether that benchmark is LIBOR or the 10-year Treasury, something like that. And that way you would have a hedge against rising rates. Your interest that you would get on an annual basis would depend on what interest rates are doing, would not be fixed, be variable, and that would be a nice way to participate if you knew rates were going to rise over time. But going back to the answer to the first question, we don't know that. I think a lot of people have started to assume that that's what's going to happen. And my natural contrarian take is that when everybody starts agreeing on something, it just feels less and less likely that that's what's going to happen. I'm not saying we're going to reverse and interest rates are going to go back down lower to where they were last year, but I'm not prepared to position portfolios for this perpetually rising rate environment. I would need to see more evidence. We're definitely getting a lot of questions from certain clients about the increase in spending or the proposed increase in spending. And I kind of find it interesting because the people who are asking those questions were not asking questions about government spending in the prior administration, and vice versa. There are people who were concerned before that aren't concerned now, and it's a political thing. And what's happened over the last 10 years, it seems like ever since we came out of the Great Recession, Great Financial Crisis, GFC, we've learned that for the time being, the debt doesn't matter, quote unquote, doesn't matter. I know people like to focus on it because it's an enormous number, and when are we going to ever pay this thing back? We may not have to pay it back. We may just refinance that debt over time and until it gradually becomes a smaller number in relative terms. Maybe it starts to come down a little bit, but it's the cost of servicing that debt that's most relevant. And I think that's why we're starting to hear complaints from some people about these new spending proposals, because interest rates aren't quite as attractive as they were a year ago. They're still really low. And it hasn't mattered. I mean, it seems like such a non-scientific answer about why you should or shouldn't be concerned about this. It hasn't mattered. The dollar is still unquestionably the world's reserve currency. It's still relatively strong versus its major competitors, the yen and the euro. And the U.S. economy is still growing, and it's still the most reliable performing economy on the planet. So it's not a great answer, but it also is kind of a great answer, because it's like, I can't tell you exactly why it hasn't mattered the last 10 years. Obviously, declining interest rates has been a big part of it. If we manage the debt in a smart way, where we don't allow it to get completely out of control before interest rates rise, then it's a non-issue. But also, if interest rates, all of this is under the assumption that interest rates are going to end up being higher, if not much higher, at some point in the not too distant future. The what could go right part is maybe that's not correct. maybe interest rates are not going to be higher, certainly not meaningfully higher, anytime in the next decade or two. If interest rates are exactly where they are today in 10 years, I don't know that the debt matters. The debt today, if we were to look backwards, I don't know if it matters all that much, especially if the economy continues to grow 2.5%, 3% on average. We'll have a substantially larger economy in 10 years and then in 20 years, and the numbers will look more manageable. That's the what could go right. That's the optimistic view of how this could go.